It happens twice a year in February and August, and it's the busiest time for a stock market analyst. It's reporting season. And being August, we're typically looking out for full year results with their typically juicy full year dividends. And dividends certainly have been the main theme of this reporting season, as a number of Australian companies find themselves flush with cash. Last year, companies braced for the worst as the pandemic unfolded, and many went to the market with massive capital raisings to shore up their balance sheets. Fortunately, the RBA and the federal government rode to the rescue with record low interest rates and an unprecedented fiscal response to a crisis. Fast forward just over 1 year, and the worst case scenario is far from what we actually got. Consumers, supported by those low rates and stimulus, did their part and kept spending. This allowed most businesses to grit their teeth, tighten their belts and forge through. This reporting season is showing us many companies have emerged from the pandemic in a strong financial position, and as a result are now looking to return excess cash to shareholders. Rio Tinto kicked off this year's August earnings season with a bang. The resources giant announced the largest half-year profit in the company's history at $16.5 billion. This is more than double the profit from the same period last year. Shareholders will be rewarded with the largest interim dividend in Australian corporate history, a whopping $12.5 billion. Rio's profits were boosted by huge margins on iron ore, which spiked to over US $200 per tonne for much of the second half. Iron ore prices have since pulled back to around $130 to $140 a tonne, and some analysts are already calling this result the high watermark for Rio's profits for the foreseeable future. Whilst this is probably the case, few analysts predicted iron ore prices would trade above US $200 a tonne in the first place, so the recent pullback probably will only have a limited impact on Rio's long-term valuation. Importantly, with Rio's iron ore production costs at less than $20 US a tonne, it's undoubtedly going to remain extremely profitable for some time to come. Major rival BHP also rewarded shareholders with a massive dividend bonanza as part of its supersized $23 billion full-year underlying net profit. BHP will return roughly $20.5 billion of this amount back to shareholders as dividends. Net profit was 88% higher than in 2020, and momentum was strong into the second half, with profits nearly doubling compared to the first half. BHP also realised huge margins on its iron ore, selling at an average price of US $162 per tonne, whilst producing at an industry-leading cost of just US $15 per tonne. Indeed, iron ore remains the main game at BHP, contributing approximately 70% to group profit. Copper was the next best performer at 22%, as the underlying EBITDA contribution from this division nearly doubled on the back of soaring copper prices. The petroleum division saw a small drop in underlying EBITDA compared to FY20, but few were paying much attention to this, as the division became part of probably the biggest headline of this earnings season so far. BHP has long sounded its intentions to offload its energy assets, and it looks like it has finally found the right solution. In a joint statement with Woodside Petroleum, the two companies announced that they would merge BHP's petroleum division with Woodside's oil and gas operations. The merger will create a combined business which will rank in the top 10 energy producers in the world. Looking at the falls in the share prices of both companies after the announcement, however, it appears neither group of shareholders appreciates the deal, which would see BHP shareholders issued with new Woodside shares to pay for BHP's petroleum assets. The merged assets will effectively be 52% owned by Woodside shareholders and 48% owned by BHP shareholders. Both companies promoted the deal as unlocking significant synergies in excess of US $400 million and delivering the expanded business increased scale and geographical scope. Shareholders aren't buying into the hype, not at least yet. Some Woodside shareholders are disappointed that the company would be left holding greater exposure to less climate-friendly crude oil assets. In the BHP camp, many shareholders have no intention of owning any more Woodside shares than they already do. Shareholders will get to vote on the deal in Q2 2022, and if approved, along with the usual regulatory approvals, the transaction is expected to complete later that quarter. The bonanza for shareholders continued in the banking sector as share buybacks were announced by 3 of the big 4 banks and Suncorp. ANZ kicked off proceedings with a $1.5 billion buyback, closely followed by National Australia Bank's $1.7 billion buyback. Suncorp then chipped in with a $240 million buyback, and finally CBA stunned the market with a mega $6.5 billion buyback. Banks were stuck between a rock and a hard place on these buybacks. They're required by regulators to maintain a capital buffer of at least 10.5%. Commonwealth Bank found itself at 13.1% by the end of June, and the others weren't far behind. A high capital buffer lowers a bank's return on equity ratio, or ROE. This is a key financial performance metric, and management bonuses are often tied to ROE targets. So the choice was to look lazy or to find a way to get that excess capital off the balance sheet. Now, one option they have is to reinvest that excess capital back into growing the business and boosting shareholder returns. Another option is to buy a competitor and grow the business that way. But these two options are complex and risky. The simple and risk-free choice for management is just to give the capital back to shareholders as dividends, or instead to effectively burn it by buying back the company's shares. Aussie investors love dividends, so that option is a lock. And share buybacks are also popular because they reduce the size of the pie for remaining shareholders, thus increasing return on equity. So it's a win-win scenario either way. Unless, of course, as a shareholder, you'd prefer your management to find you a better return than you can get in the bank, which is where your dividends are probably going to end up. In fact, some analysts have estimated there could be as much as $50 billion in dividends paid out this earnings season. That's about the size of Woolworths in terms of market capitalisation. It's not likely to stay in bank accounts earning next to nothing in interest, however, so we can expect plenty of buying from cashed-up investors hitting the market in the not-too-distant future. This should provide plenty of support to the ASX over the next few months. One final observation from the banks for this reporting season: Macquarie Group, as it long has a habit of doing, bucked the dividend and buyback trend, telling investors it intends to reduce the proportion of profits paid out as dividends, not increase it. Macquarie will lower its dividend payout ratio from between 60 to 80% of net profit to between 50 to 70%. The reason? To allow it the additional flexibility to support the business's growth. Basically, Macquarie is telling you, leave your cash with us. After all, we're Macquarie Bank. We're going to make more money on your money than you ever will. It's not just the iron ore miners that are benefiting from resurgent commodity prices. Bluescope Steel has delivered its best final dividend since the GFC as part of a mammoth full-year profit that saw profits rise over 1,100%. The pandemic hobbled a number of steel production supply chains, and better-than-expected demand from a robust US housing market underpinned a massive jump in North American steel prices to roughly double pre-COVID levels. Management warned that the good times were unlikely to persist, as steel pricing would probably be volatile after a medium-term period of continued strength. The company declared a 25-cent per share final dividend, up from 8 cents per share in FY20, and a bonus 19 cents per share special dividend. To top it off, you guessed it, Bluescope Steel also announced a $500 million on-market share buyback. So, what's our opinion on Bluescope Steel? Well, times are good at Bluescope at the moment, but is it as good as it gets? Probably, but we think steel prices are going to remain elevated rather than crash, and that means there's still some upside in Bluescope. Our rating is buy, moderate risk with a fair value target of $28.99. Dominos Pizza Enterprises shook off higher food and transport costs to deliver a 29% increase in full-year net profit on a 15% increase in revenues. Margins actually increased, however, 120 basis points to 13.3%, as the bottom line benefited from a combination of operational efficiencies and passing those price increases on to consumers. CEO Don Meij said the company's two-stream approach, which is delivery and takeaway, ensured it had a viable solution regardless of how the pandemic was impacting its customers. This was particularly the case in Europe, where Meij noted, "We've had a really good summer." He also noted that the current strong set of results were a direct reflection on the company's significant investment over many years in technology, innovation, and the online sales experience. Indeed, online sales were 21.5% higher to $2.9 billion and now account for over 78% of total group sales. The company continues to target further expansion, with management expecting to grow the number of stores it operates across Australia, Asia and Europe by between 9 and 12% by 2023. Domino's final dividend of 85 cents per share brings the total FY21 dividends to $1.19, and that's up 45% on FY20. Our opinion on Domino's? Well, it's one of the few pandemic winners and one of the most efficient and well-run businesses you can possibly buy. Definitely a cornerstone portfolio holding. Our rating, buy, low risk, with a fair value target of $152.89. It's been another disappointing year for AGL shareholders, who face continued uncertainty after a 34% slide in the company's profits. Slumping wholesale energy prices and losses from uneconomic wind power contracts were mostly to blame, and management have warned that worse is potentially still to come. They now expect energy prices to deteriorate further in FY22 and, as a result, have guided underlying EBITDA to 1.2 to 1.4 billion, down another 16 to 28% on FY21's numbers. The company did declare a fully franked dividend of 34 cents per share, bringing total dividends for the year to 75 cents per share, but that was down 23% on FY20. Our opinion on AGL, well, things continued to go from bad to worse, and we feel it's still too early to try and bottom fish this one, although we'll be watching closely their plans to split the business and salvage some extra value for shareholders that way. Our rating is avoid, high risk, with a fair value target of $5.40. Following on from a disastrous half-yearly result in February where the company downgraded earnings expectations and warned of major operational difficulties at Western Flank, BHP Petroleum has disappointed investors again. Production is down another 4% and profits are down 37%. It appears the only financial metric on the rise is costs, which are set to jump by between 13 and 23% in FY22. Even worse, looking forward, production is expected to fall another 10 to 18% as problems persist at Western Flank. Our opinion on BHP Petroleum? Well, if they can steady the ship, there's some value there in the business, but there are better risk-reward opportunities elsewhere. Our rating is avoid, high risk, with a fair value target of $1.19. We're going to close with a table showing selected major ASX stocks still to report, along with consensus broker estimates for net profit after tax, earnings per share, and full-year dividends per share. If you're thinking of investing in the earnings season winners, we're here to help. Take advantage of over 4,100 shares and ETFs on our platform, $8 flat rate trades, your own holder identification number, 24/7 customer support, and a world-class trading app. Just head to www.thinkmarkets.com/au and you can be trading in minutes. And if you like this video, please hit the like button and of course hit the subscribe button as well to stay up to date on all of our latest ASX share research videos. Well, thanks for joining me for this quick overview of earnings season so far. Don't forget to click on the link in the description to access the article on our website, which has a more detailed description of what's happened so far this earnings season and also covers earnings results for a bunch of other stocks. All the best for your trading and investing until we catch up again. Bye-bye for now.